like always say, Josh, how Ed surgery, how it's went.
I don't know. But I think we're live, and you know what? All that matters is I got Josh Letzler in the house with me, and Tommy Davidson. All right, good morning, everyone. It is the morning grind, and I am Shannon Wheeler. I am with Premier Mortgage Group. I am so fortunate to be able to host the show this morning. I am joined by a light studio audience. It's fall break time. I've realized that fall break is probably, I don't know, is it technically fall break yet? Or getting pretty close?
Week. I will be leaving on Friday.
Yeah, the town empties out around fall break. You know, where are you headed?
Take a leak.
I know, on Friday. Headed to Florida?
Florida. Going to Florida.
Very good, very good. Okay, so this morning we'll start the show out just like we always do. And just because we have a light audience, it does not mean that we're going to start the show any differently. So Josh Letzler, tell me, sir, what is it that you are thankful for and grateful for this morning?
I'm thankful that I get to grind in here by myself this week. The only one in here.
That's right. That's right.
Hey.
Yep. Well, as far as back in here, because Hayden will be up there, so back here, you're the king of the roost.
That's right.
Do you have any practical jokes in mind for everyone? Are you gonna glue, Josh's chair to his desk, or you should think of some. Yeah, you got to think of some hijinks.
That's right.
Yeah. But at any rate, so this morning, I thought we would talk a little bit about some creative finance.
Ooh, what is
so,
creative finance?
Creative finance, Tommy Davidson, is the method of finding new and different ways to help people secure the properties that they want to secure when the normal ways may not give them that chance.
Hey, I got something to add.
All right,
I
add.
got a feeling this area will be the most productive it's been in a while.
You think so?
Because Ed's not here. Oh my goodness. It's pretty bad when you're not here and it's a net positive.
Yes.
So
yes.
okay, so let's talk a little bit about some creative finance. Josh, what do you think? You're a little bit newer to the business. You've just now started getting friendly with finance, getting familiar with finance, but did you know that there are many ways to skin that cat? So you may have in your short career already run into situations where you've got somebody who maybe has a house that they need to sell, but they can't get an offer accepted on the house that they're trying to buy because they haven't sold that previous house. Have you run into that, you and Josh? Mm-hmm. All right. It's a pretty common sort of trap people find themselves in. So one of the ways that you can overcome that is using bridge financing. So what people watching the show may not know about creative finance is that when you are looking at a situation, you oftentimes find yourself needing to trade money for time. Tommy, you know a lot about trading money for time. That's a big thing. So I've got a situation where we've got a potential borrower, who has a house that they need to sell, and they've got a house that is coming under contract or is under contract that they're looking to purchase. So the challenge that they've got is their income will not allow them to carry the current property and the mortgage that goes with it and qualify for their new property. So if you're out there watching the show, or if you're a realtor and you're watching the show and you've got a client and you've got a contract on your desk that is just sitting there needing to move somewhere, and you can't get that house sold and they can't get closed on their new one because they can't carry both payments, that's where creative finance comes in. So in a typical scenario, that person could refinance their current house and get some cash out and use that cash to buy their new residence. That's one way you can do it, but you have the same issue of needing to qualify for both of those payments. So what's happening is, and one of the other subtopics of the show today under creative finance is where there's a will, there's a way. So what's happening is, now that the market is shifting to that type of market where you have tight inventory, you still have high prices, but you've got people that are wanting to move, rates being up a little bit, compresses their income that they have to qualify, so you have to get a little creative. So all the lenders out there are trying to find those new ways to help people move. One of them is with bridge financing. Are you familiar with bridge financing? Have you ever heard that, bridge loan? A lot of people have heard the term. What people don't really realize is that a lot of bridge financing or bridge loans, there's not really a lot of technically accurate bridge loans out there. So a bridge loan technically encumbers both properties. That's not something that's typically there. What you're really talking about when you talk about bridge loans or bridge financing is you're finding a way to get the equity out of your current house to help you buy your new house. Now, here's where bridge financing starts to break down. Let's say you have a house that you live in now at 123 Lucky Lane, and you're trying to buy 456 Lucky Lane. If you have to have bridge financing, first of all, it's hard to find places that will encumber both properties. So you've got to be able to have a loan on one to buy the other. The second thing that happens is you still have to qualify for that payment. So lenders now are doing what's called non-QM or non-qualified mortgages, which basically are new products that address things like that in the market. So one of the lenders I just met with this morning is a guy I've known for a really long time, 25 years, he's been in the business, and he has some new products that help address this. So he's got a product where we can do a loan on 123 Lucky Lane, the current existing residence, and we can take the equity out of that property and put it on an interest-only loan for 12 months, and you don't have to qualify for that payment. So you can then buy your new home with a regular or with a non-QM
What if you
loan.
don't have any equity? You're just trying to, let's say this. What if you bought a home a year ago, you're wanting to move, you don't have any equity?
Yeah, now if you don't have any equity, you're not going to be a candidate for this solution.
Can you when you're done with this, can you talk, how hard is it to assume loans? Is that something that's coming back, or, I mean, a lot of us don't even know what that means.
Yeah. Oh, we can talk about it right now. We don't even have to wait till after the show because that falls under that creative finance category. So with assumables, the first rule of thumb is assumable loans, and the ability to assume a loan is going to rest with the current note holder. So if the current mortgage company allows for it, then you can. Typically, it's going to be for owner-occupied. So, for example, if you want to buy 123 Lucky Lane and you're going to live in 123 Lucky Lane, you can potentially assume that note. If it's a current VA, you have to be a veteran to assume it. I've heard of some instances where they would let a non-veteran assume a VA. I'd like to see that in writing before I'd like to see that happen before I would really bank on that. Because VA, but if you're a veteran, you can assume a VA. FHAs, you can assume if the current lender allows you to do that. And whether they're coming back or not, I don't know how prolific they're going to be. Where that really ticks up is when you have investors that want to assume loans. But for the most part, it has to be owner occupied. Yes.
Can you, if you have a seller that wants to advertise their loan as assumable, can they assume the rest of that loan and then get another loan for the rest of the purchase price? Like if they want to, so that the interest rate is lower, like say they have a 3% interest rate. And
that's a great question. What a sterling creative finance question, Mr. Letzler. Yeah, that is a great question. So, yeah. Hey, Trish, what are you thankful for this morning?
That I'm here.
Are you on the show?
Nice.
Are you on? Get on there. Come on, help us out.
Okay, so in answer to your question, you can assume the underlying mortgage. You can get a loan for that equity portion. That's not allowable. It would be up to the lender that currently owns the loan. So let's say, for example, you've got a house that's $500,000 as the purchase price. The underlying mortgage is $200,000. You've got to figure out how to bridge that $300,000 extra. So if you are allowed to assume the first, then you can get an equity line or a second mortgage put in place for a portion of that equity. So if the purchase price is 500, underlying mortgage is 200, you may be able to get a loan for as much as 200 of that equity, but you'd still have to have 100. And it's a great point, because that's where a lot of people run into challenges with assuming loans. So I'm a veteran. I've used my VA loan 10 times. However many, 8 or 10 times, something like that. So if I wanted to move right now, I would probably look to assume a VA, because the rates are going to be super low. But if I did, I would have to make up that equity difference between what I'm buying the house for and what that veteran's loan is underneath. Now, a VA loan, I don't think they would allow you to assume that and assume it with a second behind it, right? So it's going to be one of those where the underlying mortgage is going to have the first call on what they allow and what they don't allow. And it can be difficult sometimes to get that second mortgage put in place if you're assuming that first.
Drew said he just assumed going in an FHA in Lebanon on the show.
Okay, good deal. So tell us about that. Assumed an FHA. Well, you can assume. I'd like to find out. I don't have a. You can assume you can do a. Did you do sub 2 financing? So I don't know if I'm on the. See, in other words, you can do a subject to financing deal, and that's sort of an assumption. It's an assumption like product, but it's not a straight assumption. So I'd like to find out about that. So in other words, you can assume a property, take ownership of a property. That's not quite the same as assuming the FHA. So who was that? Is that Drew that said that?
Drew.
I got you. I thought you were talking about our Drew. That's not our Drew, is it? Okay. So I wonder if that was a sub 2 finance deal, which you can do those, and the FHA that's there stays underneath, and you assume the property subject to the underlying financing. That's different than I'm an investor. I'm not going to live there. I'm going to assume that FHA loan. So that would be a new one on me. I'd like to hear some more about that one, because if that's the case, I'm going to go between now and lunchtime, I'm going to get about 100 because that's a great deal. So again, though, that all falls under that category of creative financing. And sometimes you have to get creative. And what happens typically is if there is a will, there's a way. So if the person that is wanting to move has the ability to understand that they may pay a little bit of a premium for that solution in the short run, then that's where creative financing comes into play. So if you're out there and you're trying to figure out how to move, you want to move, you just can't quite figure out how to make the dots connect, give us a call. We can help you out with some creative financing solutions. If you're a realtor out there or an investor out there and you want to continue to grow your portfolio, that's when you need to call me. We've got what's called DSCR, debt service coverage ratio loans. It's another form of creative financing. In that scenario, if you have a property, let's say you've got 4 or 5 rental properties and you want to continue to grow your portfolio, and you've got some cash to put down, but you don't have the ability to ratio, or you have non-traditional income, or you're self-employed and you write it all off, but you want to continue to grow your portfolio, then we have products that, as long as the principal and interest and tax and insurance payment fits under the rents that are average for the area. So you have the appraiser do the appraisal. Then they also do a Schedule 1007, which is a rent schedule. And let's say, for example, you have a property that the rents in that area dictate that that property would lease for $2,500 a month. And then you put down 10% or 15%, and you've got a principal and interest, tax, and insurance payment that comes up to $2,450 a month. You're approved. That is the qualifying. It doesn't qualify you based on your earned income. It's simply based on the property. Those are getting to be super popular. They're called DSCR, which stands for Debt Service Coverage Ratio. So if you're out there, you're trying to get some properties moved, you want to get some things going, expand your rental portfolio, those kinds of things, where there's a will, there's a way. Contact us about creative financing. Other than that, take us out, Van.